That's the potential in terms of long-term returns from India, somewhere between 13 to 14% post expense. Again, risk has to be defined as permanent loss of capital and not volatility. I suspect, given where the valuations are today, markets may go nowhere over the next 6 to 12 months as well. 5% of the times in the last 20 years, a 5-year SIP has given a single-digit return, but the average 5-year SIP returns are still back to that same 14% magical number. This will actually be a good time to increase allocation into equities. Real estate has never given returns higher than equities. Whenever on a trailing basis, gold over a 10-year period gives near or higher returns than S&P 500 and Sensex, that's typically the time when gold would have peaked in terms of returns. Will be more comfortable holding gold than silver at this stage. Even if AI bubble gets pricked, it is not going to go down the same way as the tech bubble did because the balance sheets are extremely different. We used to have PMS, we've shut it down. By the way, it's a known fact, asset managers collect significantly higher fees in PMS and AIFs compared to mutual funds. If you simplify things and look at the basics around what helps you create the best returns, you would and you should gravitate towards mutual fund products.
A very happy 2026 to all of you. A new year brings fresh energy and in investing, fresh questions. Instead of adding one more forecast to the mix, we thought it might be useful to pause and zoom out, to look at investing not through predictions, but through the choices and decisions that shape outcomes across equity, debt, real estate, gold, and alternative assets. In this conversation, we'll try to answer some simple but important questions. What should you really focus on? What truly matters over time? And what deserves a little less attention than we usually give it? Joining us today is Mr. Ajay Tyagi, Head of Equities at UTI Mutual Fund, a CFA charter holder from the CFA Institute USA. He has over 26 years of rich experience. He strongly believes in being prepared, and that reflects in all interactions we've had with him. We couldn't think of a better person to help us kickstart this new year with the right perspective and clarity. Thank you, sir, for joining in. Wishing you, your family, and everyone at UTI a very happy and prosperous 2026.
Thank you, Megha. Glad to be here and very kind of you to get me onto this conversation right at the beginning of the year itself.
So, sir, let me begin with the first question. Every market cycle leaves some kind of an imprint. And if we see the last 5 years, especially from July of 2020, it looks like the market has had a secular run. As a very senior fund manager and a practitioner, what is one thing that you would like to leave behind and probably relearn, and would also urge our investors to think about as we enter into the next 5 or 10 years of investing, so that there is no deterrent as far as their wealth creation journey is concerned?
Megha, through the course of the conversation today, I would ad nauseum, use this phrase of EQ being more important than IQ. I think if you ask me, my one learning of the last 26 years is that people who think that markets can be predicted, patterns can be drawn, you can look at historical behavior to extrapolate the future, i.e., thinking on lines of how their intelligence in analyzing data can help them create great returns, ultimately meet with disappointment. Markets are essentially about being emotionally very stable, having a plan, and then sticking to it with discipline while observing how different asset classes have generated returns in the fullness of time. So, I will be repeating this again and again over the course of our conversation today. But since your first question was about how the markets have behaved in the last 5 years, what are our learnings? I am tempted to say that investors ought to actually look at the last 5-year period as a bit of an aberration in terms of the supernormal returns that they have been able to collect. And this is not something they should be expecting from the next 5 years. Last 5 years in terms of how markets have behaved, to my mind, is not something that should be extrapolated or can be repeated by markets every 5 years. we haven't seen a very serious drawdown anytime in the last 5 years. In fact, if I look back over the last 10 years, the only serious drawdown that we saw was in Feb, March, and April of 2020, but that was very short lived. And in a way, the behavior of the Indian markets over the last 10 years has basically made investors believe that a correction basically is all about just a few months. A correction basically means that markets give no returns or low single digit returns for 12 months, and that's it. But that's not how equity markets behave. You can actually see prolonged periods of correction. You can also witness, strong negative returns, even over a 5 year period, by the way, at times, of course, at the extremes. So therefore, my, one learning is that investors ought to be told very, very passionately that please don't try and extrapolate your last 5 year and last 3 year returns into the future. Please be mindful of the fact that the average return that an investor can expect from Indian equity markets is somewhere around 13-14%. There is a very simple maths for this, by the way. India's real GDP growth should remain somewhere around 7%. I am building an optimistic case here, by the way. Add a 4 percentage point on top of this, which is basically the normalized inflation. 4 or 4.5% should be our normalized inflation. That takes us to 11.5% nominal GDP growth. Of course, as fund managers, we are paid to select companies which are growing faster than India's nominal GDP growth. So add another percentage over there, or a couple of percentage points there. So that makes it 13.5. And add some dividends, add a dividend yield of around 1%, that makes it 14.5%. Now that's the potential in terms of long-term returns from India, somewhere between 13 to 14% post expenses. If you have collected returns which are 16, 17, 18% in the last 5 years, please do remember that you have borrowed from the future. And this has happened only because, in terms of valuations, markets have gone higher than their average levels. At some stage, they will at least come back to their average levels, if not go all the way down. And please keep this framework in front of you. And that's why don't start beating yourself if you start seeing your last 1 year return or 2 year returns to be just about 10% or 5%, or low single digits. This is only bound to happen. The longer term potential is what should drive you in terms of having a plan in front of you. Yeah.
So, sir, you made a very important point that, EQ is more important than IQ. I think, it just not holds true for investments, but everything in life at a certain level. So, just taking, cues from your answer, if you see the last year to 15 months, we have seen a period of prolonged, time correction. Now, as advisors, when we have a time correction, we can actively manage the portfolios by, using tips to further accelerate the movement into equity, so on and so forth. However, this year was different that different asset classes, which are typically uncorrelated, also did well, whereas equities went through a period of time correction. Now, this creates some kind of fatigue and boredom, the investor. Now, I'd like to understand from you that in your last 26 years, I'm sure you've witnessed maybe longer periods of time correction. And what is that one key mistake you have seen investors making and which they should be very mindful of so that consciously we can avoid making that mistake?
Yeah, you use the word boredom. Let me tell you, Mega and Harsh, boring is good. When it comes to equity markets and equity investments, boring is indeed good. Exciting is actually very, very dangerous. And, I really get worried when investors get too excited about the market. So, since all of us in this game are, here for maximizing our wealth over the long term, I would say one phase which is something which always keeps me happy and positive is when markets move sideways, markets are drifting lower, there is massive boredom, people get doubtful and suspicious about the potential of equities and so on. Because this is indeed a phase where froth is getting corrected, where valuations are, coming down and therefore getting into the attractive zone. We are into one such period right now. Markets have gone nowhere over the last 12 to 15 months. I suspect, given where the valuations are today, markets may go nowhere over the next 6 to 12 months as well. But that is good. This is, to my mind, one of the best periods to continue on your SIP journey. Look, please remember, let me give you some statistics. And, it's not important to be precise in terms of the number, but I'm just trying to give you the direction. We talk about long term investing, and we usually urge our investors to look at least for 5 years or beyond. Let's take 5 years as the cutoff. We did this study on Nifty 50 in terms of doing a 5 year SIP on Nifty 50, monthly SIP on Nifty 50 for 5 years. We went all the way back to 2005 as the starting point. There are two surprising things that came out. In 2009 and 2020. 2009 was the phase when we went through a financial crisis. This was a global financial crisis, and February 2009 was the low point. From there, the market started to move up. Similarly, we went through a pandemic. The low point was sometime in March 2020, post which the market started to move on. At these two low points, by the way, 5 year SIP returns on Nifty went negative. And somebody would have said that, look, you talk about long term and you talk about, if you have a longer time horizon, you won't lose money. But look at extremes, you will end up losing money even in a 5 year SIP. But that's no way to measure the success of your plan. The beauty was that within 1 year, within 12 months of both of these phases, the same SIP started giving close to 13-14% return. The fact is, markets were unnaturally low at these 2 points, just like they were unnaturally high in September, August of 2024. But this is an extreme. Let's not live at the extremes. Let's talk about data in its fullness. The interesting point is that approximately 25% of the times, the same 5 year SIP on Nifty has given single digit return. We obviously want at least a double digit return and at least a 13-14% return. That's something which we all keep talking about, somewhere between 12 to 14% return. 25% of the times in the last 20 years, a 5 year SIP has given a single digit return. But once again, it's no way to measure the success of your plan. The average 5 year SIP returns are still back to that same 14% magical number. So here's the thing. You may enter into a phase in the next 12 months when even your 5 year SIP starts to, give you a return much lower than what you were used to looking in the last few years. Maybe it comes down to 12, then 11, then maybe 10, who knows, maybe single digit. But do remember, these are phases where you have to continue doing the same. Don't feel bored about this. Don't feel that you have to move your money from equities into something else. This will actually be a good time to increase allocation into equities. And therefore, while none of us can forecast the markets, but yes, looking at the valuations, we truly feel that maybe the markets remain sideways for some more time. It will end up being actually a good time to make fresh investments, let alone SIPs. SIPs should not be touched at all. I mean, that's the whole discipline around this investing. That's the plan that you have to create wealth over the long run. So don't touch SIPs. Maybe, if markets truly correct some more, I would actually advocate lump sum investing, which we are not advocating just yet.
So, sir, you said, investing in equity should be boring, and most often than not, our investors and us alike think fixed income is the boring part of asset allocation. However, we have seen that, when equity returns start looking muted, as they are looking right now, there becomes an increasing trend as far as single issuer bonds are concerned, who kind of promise higher assured returns, and the fact that it is assured often lures investors to fall into that trap without probably understanding what the credit risk is likely. Now, in an environment where the interest rates are falling, global macros don't look great yet. What are some of the important criteria which investors should look at from the lens of liquidity, credit, and reinvestment before entering fixed income?
This is a very interesting question, Megha. Let me start by saying that we must first of all understand, why do we have fixed income in our portfolios? Is it for maximization of returns or is it for downside protection? Actually, if you ask me, and there is obviously documented literature around this, Fixed income is that part of your portfolio which provides stability to your portfolio. It is not to maximize returns, it is essentially to provide stability, because who knows? I mean, the world can go through a crisis, and when a crisis happens, all asset classes start to come down significantly. The correlation actually that we say, which the low correlation that we see between different asset classes and between different economies, which is the reason for diversification, unfortunately, during such global events becomes very, very high. So whether you are a US investor or an Indian investor or a Japanese investor, everybody will witness markets melting down. You could be a investor into different sectors, but all of them will show the same price behavior. At this juncture, even though bonds can come under pressure, but they do provide significant downside protection. And therefore, to my mind, the single most important reason for having an allocation into fixed income is essentially to protect downside, to provide stability. Now, if that is really the reason, then why do investors start looking for return maximization within their fixed income portfolio? And if you ask me, the entire financial crisis that happened in 2008 and 9 was just a manifestation of this behavior. For those of our investors who may or may not recollect what happened in 2008-9, it was also known as the subprime crisis. That was the time when people were buying these subprime bonds, which were yielding huge returns because the underlying was a poorly rated borrower in the real estate market eventually. And this game went on for a few years, but it busted in 2008 and it had massive ramifications globally. In 2018, by the way, exactly 10 years later, we had a similar behavior. Of course, it wasn't as debilitating as the 2008 episode. It didn't actually derail the economy completely for us, but it was, of course, a limited event, and it was, an event which impacted only the Indian economy, not the global economy. And once again, this was around, the low-rated bonds and the high-yielding bonds, which had become so popular in 2016-17 before they finally busted in 2018. People lost their shirt at that point of time. Fixed income, which was supposed to provide downside protection, actually couldn't even protect the principal. And once again, those hard lessons were learned. It's unfortunate that we've forgotten all of these lessons once again in 2025. I hope that we don't repeat, the mistakes that have happened previously. But once again, I want to very fervently, let investors know and remind them that you have invested certain part of your portfolio into fixed income for downside protection. Don't seek to maximize returns from there. If equities are not giving you returns, just be patient rather than taking money out of equities and putting into something else, which in the very near term holds the prospect for giving higher returns, but essentially can be extremely risky for you. So to cut the long story short, Megha, I would say that investors' portfolio can be invested into equities, into bonds, some bit of allocation into gold, some bit of global diversification. These are all essential. But wealth maximization ought to be out of exposure to Indian equities and global equities. Gold and bonds are there always to protect downside for us, not for wealth maximization. Yeah.
I think it's also important to highlight that, the loss in fixed income can be permanent, unlike equities. I think sometimes we, forget sight of that.
Sorry to cut you, Megha. That's a very valid point you've made that when you end up making losses in fixed income, you basically are talking about permanent losses, close to permanent losses in equities. See, once again, risk has to be defined as permanent loss of capital and not volatility. Many investors confuse this. If equity markets are volatile and they fall 20-30%, if you are essentially invested into businesses and you're holding stocks of good businesses, that's just a very temporary phase when stock prices have gone down by 20%. If this business continues to do well, these stock prices will go up once again. So you just have to weather that uncertain period. Essentially, these low rated bonds and high yielding bonds are poor businesses. And if they go through bad weather at times, then their loss can be pretty much permanent. Their balance sheet just blows out. So rather than protecting downside, you're actually talking about losing your capital. And in fact, that's the biggest risk in one's portfolio, permanent loss of capital. Yeah.
We see an increasing trend that because real estate has done well in certain geographies, of course, and capital markets have also done well. Investors want to book profits from the capital markets and redirect it towards land deals and also towards tokenized fractional ownership. Now, they're kind of extrapolating the returns of the last 5 years into the next five. I'd like to understand from you, do you believe this enthusiasm is justified to some extent? And what are some of the risks that investors should not overlook, particularly in terms of liquidity, governance, and pricing opacity, which real estate brings as an asset class?
An excellent question, Megha. Let's first take a high level view and then we'll get a little micro. Look, the high level view, whether you look at Indian economy or global economy, is very, very clear. If you look at 10, 20, 30 years, in fact, in US, you have data going all the way back to 100 years. Real estate has never given returns higher than equities. And the data is evidence is abundantly clear. So why do people fall for it? I think people fall for it a lot because of looking at micro markets, looking at conversations with their friends or relatives, and the experience of these friends and relatives with a particular micro market in which they may have made, huge money, and then people get tempted towards it and try to, replicate that entire thing to make returns. Well, if you're lucky, you can, but I will still go back to the evidence of uh, equities giving you a much higher absolute return and also risk adjusted return to remain into equities as my predominant allocation for wealth maximization. Please do remember that when you look at certain micro markets and certain success stories, instead of comparing it to the returns of the markets, which are like we have discussed around 13-14%, you ought to be comparing that with the success of a company like Bajaj Finance over the last 10 years. Only then it will be an apples to apples comparison. Comparing a particular micro market with the equity markets as large is not apples to apples comparison. So therefore, please be mindful of that. At the aggregate level, real estate gives lower returns. At the micro level, please do the right comparison. That's point number one. Point number two is look, taxation is a real cost. And you have to look at your returns from real estate and compare them to equities post tax and not just pre tax. Point number three, are we really talking about an asset class which is transparent, which is liquid, where if you feel like exiting tomorrow or within the next 1 week, you can do so without any heartburn and very effectively? Once again, make those comparisons against equities, whether it's by way of mutual funds or by way of direct stocks. I would say by way of mutual funds, certainly the transparency is extremely high. You can liquidate your portfolio within 24 hours, get your money within 48 hours, and so on. Taxation is abundantly clear. So all of these things, if you evaluate real estate versus equities on all of these parameters that we discussed, I would certainly say that once again, for the wealth maximization part of my portfolio, I would invest to equities any day over real estate. Of course, all of us need a home. So, therefore, all of us do need to zero in on some piece of real estate in the city of our choice, in the neighborhood of our choice. So, to that extent, I can never undermine the importance of real estate. By the way, that's the single biggest purchase item we do in our lifetimes. So yeah, I mean, if you're buying real estate because you want a home for yourself, obviously, go ahead. If you're buying real estate because you think that's the best way to compound capital, I don't think so. There is hardly any evidence around that. Yeah.
And sir, additionally, thanks to the evolution of real estate market, we have certain well-governed instruments also like REITs and maybe even listed entities in the real estate where also you get a play through equity market in real estate participation. So now from one physical asset to another one, and this is about an asset class or a category which did phenomenally well in 2025, and I'm talking about gold and silver, and the kind of return which these gave. I think this is equal to the decadal return which you expect generally from both gold and silver. Now, the mindset of the investor is that generally gold and silver never give any drawdown. There are no negative return periods. But if we go by the data, we have seen phases where gold and silver had tough times also. So, for example, if I talk about silver, the price which it had in 2010, 2011, it touched the same price in 2025. So there was a waiting period of 14 years before it recovered its original price. And if I look at gold also, we have seen period from 1980 to 1982, 1996, and then 2012 to 2015 also, where we had significant drawdown. Now, there are two questions here. One, getting into 2026, is the enthusiasm around gold and silver justified? Should one be still building position in this? And second, somebody who has zero exposure in this. And generally in India, we don't have zero exposure in gold or silver because we have some allocation in the form of physical gold or silver. But if I ignore that, somebody who has zero allocation in this, what should be the strategy for that investor?
Right. I think this is a great question. This is one question, Harsh and Mega, where we are perplexed ourselves. So I'm not going to give you a very emphatic response to this question because we love to be brutally honest with our partners. Now, but I would give you how we are looking at this and why are we perplexed about this. Point number one, when we look at the behavior of gold versus equity markets, and here equity markets for us mean S&P 500 in the US and our own markets, which is, let's say, Nifty 50. Whenever on a trailing basis, gold over a 10-year period gives near or higher returns than S&P 500 and Sensex, that's typically the time when gold would have peaked in terms of returns. So whenever the trailing 10-year returns for gold are either equal or slightly higher, we know that gold as an asset class has peaked, and like you mentioned, those phases in the last 30 years, maybe it just goes sideways for the last few years. That signal has come to us already, by the way, in the last 6 months itself. So that's very, very clear that possibly gold should take a breather right now. Where we are getting confused is the fact that first time in many decades, post Bretton Woods system, I would say. So you can talk about more than 50 years already. First time we are seeing this behavior of central banks trying to hold more of their reserves in gold and less of dollar reserves. People call it de-dollarization. I'm not going to get into that debate. That's a different debate altogether. But the data is very clear once again. 2015-16, global central banks had 62% of their reserves in US dollars. Today, the same number, 10 years later, has come down to around 45%. And there has been an acceleration in the last 4 5 years itself. If you look at that curve has been facing down for the last 10 years. So, which means that every year, the reserves in US dollars were coming down and the reserves in gold were going up. But there has been a bit of an acceleration in the last 3 years. Now, that is something which is, in a way, a data point which we are onboarding, and therefore we are stopping short of saying that look at the behavior of gold from a return perspective. Gold returns have peaked because if central banks continue to buy gold, their behavior is not driven by the potential of gold in terms of providing returns. Their behavior is only determined by that. Look, should we just continue backing the dollar or should we have a higher percentage of gold in our reserves? And we know some of those central banks which have taken a very, very clear view of de-dollarization. If that behavior continues, who knows, gold goes up another 10-15% even from these levels. So that's why we are not so emphatic in our call on gold, because we are unable to read the minds of central banks who have been at this behavior for some time now. Part of the question was, should investors start investing in gold? What if some? So look, discipline has taught us there is never a right time or a wrong time. If you would have asked me this question, is it a good time to invest into equities? What if a new investor comes to me? What should I do? I would say, obviously, get him into an SIP, draw asset allocation plan for him. Within equities, draw a plan for him, how much in large, how much in flexi, how much in mid. Do the same. I would say if an investor has come to you who has nothing in gold, I would say gold does deserve a between 5 to 10% allocation in anyone's portfolio. Get him started instead of just waiting for that perfect time. If nothing else, multi-asset allocation funds do have between 10 to 20% allocation into gold. Get them started over there. Yeah.
And so what about silver? Because that is also a question which is being asked by investors in terms of taking additional exposure. And if somebody has zero position, what should he do?
Now, here our view is slightly more emphatic. Silver is an industrial commodity. Silver has its own demand supply factors which are not related to central banks. Central banks cannot use silver as a reserve currency. Do appreciate silver requires huge amount of space, even to store a small value of silver. So it can never be a reserve currency. So silver will not be driven by central bank decisions. Silver is driven by its own demand supply factors. The demand today for precious metal like silver is also because it's going into alternative sources of energy like solar panels. Now that itself will have its own life cycle. But if you were to ask me this question between gold and silver, I would say I will be more comfortable holding gold than silver at this stage.
So now, moving from an asset class which is traditional, like real estate or precious metal, to something which is not very new, but it's seen, some kind of an exposure in HNI portfolio in the recent times. And here I'm talking about alternative assets. And sometimes internally we discuss that HNIs have curse of connection, where you meet so many people and they invest in certain ideas, and you also get tempted to invest in those ideas. Many a time it is with due diligence, and sometimes it's without due diligence also. Now, I'm talking about categories like PMS, AIFs, and even private market products. Now, what I understand also is that as a fund house, you used to have a PMS, which you don't have now. So, for an investor who's building a strategy around alternative assets in 2026, what should be your two bits of that?
You've touched a question which comes up in multiple conversations. Let me start with the wisest man when it comes to investing, which is Warren Buffett. And for the last 10, 15 years, he's been advocating how investors need to get into passives if they are confused and if they know nothing about it. Sorry, if they know nothing about investing in general. And in fact, he's gone on to say that I'm going to transfer all of my wealth for philanthropy. And people have asked him that, then what should be the best way to manage it and so on. And he said that, look, just invest all of this into a few index funds and that's it. That's the best way to create wealth. Now, if I just take a cue from there, then there are quite a few points which are relevant for this question that you have made. Most HNIs want to come out of PMS, I'm sorry, come out of mutual funds and invest into alternates like an AIF or a PMS because they just feel that this is such a simple structure where anybody can invest, where a person with only 5,000 rupees can also invest. So, therefore, why should I be there in a structure which is catering to the public at large? Without realizing that money has no color, the best returns can come from the simplest of the structures and the most non-complicated of the structures. And, like I said, the wisest man is also saying that keep things very, very simple. That's point number one. I think it's just an urge to be a little different rather than evaluating the product on their merits. You made a point about we used to have PMS, we've shut it down. Harsh, the point was very, very simple for us. By the way, it's a known fact. Asset managers collect significantly higher fees in PMS and AIFs compared to mutual funds. And then there is, and I'm not even talking about success fees here, by the way, or performance linked fees, by the way. I'm just talking about the fixed fees, significantly higher. Distributors actually do the same. I'm glad that you and Mega are talking about whether mutual funds are better than PMS because I'm sure you can collect a much higher distribution fees by selling an AIF and a PMS compared to a mutual fund. But if you're still sticking to a mutual fund and advocating that, it really means that you have your client interest in mind. We too had our client interest in mind, and we were driven by just one simple thing, which is that look, mutual funds are not amenable to taxation when we make any changes in our portfolio. If I were to sell Eternal today to buy Swiggy, or if I were to sell Bajaj Finance today to increase exposure in HDFC Bank, whether it is a short term or a long term tax, we pay zero. Only when the end investor finally takes his money out after 3 years or 5 years or 10 years, he pays a long-term capital gains. In case of PMS, the minute you do any churn, you pay taxation. And we know that today in India, even long-term is taxable. 5, 6 years back, long-term wasn't taxable, only short-term capital gains tax were there. And now, both are taxable. Every time you make even the slightest of change in a portfolio, your return potential goes down because you end up paying taxes. So on a post-tax basis, we realize that this product can never ever match up to the return of a mutual fund because of taxation, number one, and number two, because of the fees. Both these factors put together, investors don't realize can make a huge dent on their overall return over a 5 and 10 year period. Look, there is no magic. It's the same universe of securities available to either a mutual fund manager or a PMS manager or an alternative, as in an AIF manager. And if we are drawing from the same set of securities, but one structure is not paying taxes and has the lowest expenses, whereas the other structure has higher taxes and, of course, higher fees, and the third structure may be as efficient in taxes but certainly has higher fees, shouldn't the decision be fairly simple? And that's where I say that, look, it's driven by this urge to sound different, to actually brag amongst their friends and acquaintances that I have invested into so and so AIF or PMS. There is no sexiness about investing into a mutual fund product. It's a very mundane, simple product, but there is some sexiness about investing into, private credit, into AIF, into PMS, and so on. But do remember, this is a game where you have to simplify things. And if you simplify things and look at the basics around what helps you create the best returns, you would and you should gravitate towards mutual fund products. Yeah.
Understood, sir. Well taken. So now we are at the beginning of the year, and generally many investors build expectation about the year, though it's just a calendar year change, and nothing is changing with respect to the earning outlook of the company. But still, going by what investors feel at the start of the year. Now, most of investors, including us, we get our opinion formed through news, and there's a lot of noise around us, and it's very difficult to filter that. So, if we have to guide our investors for the foreseeable future, what is it that you see globally at this point of time and even locally, which is noise and has no implication to fundamentals, and it's being touted as huge risk? And on the other hand, what are some of the risks which nobody's talking about, but they could actually be important risks to consider in this year?
Sure. So let's talk about the narratives, which is sucking in a lot of investors. I think let's talk from a global perspective. It certainly is AI. That is something which is catching everybody's imagination. Now, I also know that there are certain suspecting investors who have already started drawing a parallel between AI and the tech bubble of 2000. Let me get that off the way first. We've done enough research on that to reach to the conclusion that even if the AI bubble gets pricked, it is not going to go down the same way as the tech bubble did because the balance sheets are extremely different. The cash sitting on the balance sheets of these top 10 companies in the US is into hundreds of billions of dollars, which wasn't the case 25 years back when the tech meltdown happened. At that juncture, many of these big companies, which finally went down under, were having debt sitting on their balance sheet. Their margins were very poor. Their return on capital was very, very poor. So the good news is that uh, right now, the health of these companies which are at forefront of AI and which are making billions of dollars of capex into AI is very, very sound. They can absorb this shock. Now, the bad news, of course, is that there are a lot of expectations from these companies. People have certainly extrapolated their earnings growth well into the future. And I think if there is any negative surprise that shows up in terms of the use cases of AI and therefore the return on investments that these Mag 7 companies are making, then it is definitely going to be a dampener. Do remember that if we dissect the performance of S&P 500 between Mag 7 and non-Mag 7, there is a huge difference. Mag 7 is driving all of the returns for S&P 500 minus the Max 7 S&P 500 returns will be single digit and not 13-14% that we have been seeing over the last 3 years and 5 years. So that's one thing that we have to keep in mind, that while this may not completely derail the boat because the balance sheets are strong, but only time will tell whether the return on investment on this massive AI capex that all of them are indulging into does turn out to be strong. Are there enough use cases? Or like the electric cars, this is also going to slightly come down in terms of the narrative. I mean, just yesterday, we know the European governments are now debating whether they should be committed to their 2030 and 2035 targets in terms of electrification of cars. Maybe, in AI, we do get a reality check after a couple of years. So that's something we must be conscious about. Look, we all must diversify outside of India. US has always been my preferred market to diversify outside of India. But one word of caution, that almost like India, the returns from the US markets should not be extrapolated. They will go through a breather. They will still remain a very solid case for diversifying out of India and investing some part of our portfolio, but be conscious of the fact, have your expectations right in terms of what the US markets can yield over the next 3 to 5 years. On the Indian markets, I think there are 2 or 3 things that can go wrong for us. Look, we were hoping that there would be some closure in terms of tariffs. There still hasn't been. In fact, I was also in the camp, wrongfully so right now, I should say in hindsight, where I was expecting something to come up after the Bihar elections. We haven't seen that happen. So there is a tough game being played between the White House and our government here. And the longer this tariff game stretches, it is definitely going to be negative for India. It is definitely going to hurt our exports to the US, even if they are small. We do need a closure to this entire thing which is playing out. India is sticking out as one of those countries which essentially in terms of diplomacy is close to the US, but in terms of the economic deal making is one of the worst impacted. The second thing which can go wrong for us is, what if our earnings growth don't revive in the coming quarters? There is already expectations. I keep looking at the consensus numbers. While our last 2 years, which is financial year 25 and financial year 26, our earnings growth for 2 years on an average has been just around 6-7%. What is getting built into the prices today is about a 15% earnings growth in FY27. We are starting the year with the expectation of 15%. What if we don't reach to that 15% for one reason or the other? My own gut feel is that consumption should revive, because there has been impetus in income tax, there has been impetus by way of GST rationalization, and these two put together is like $33 billion in the pockets of consumers at large. So consumption should revive, but the government is also looking at its fiscal deficit, and therefore there would be less money left for capex. Defense is something they won't touch, but minus of defense, there will be less money on capex, which means certain industries will benefit, certain industries will not benefit. Therefore, I'm slightly suspect about this number of 15% earnings growth. Hopefully, we go back into double digits, but may not be 15%. That may be, a bit of a dampener to the markets. The last thing is, look, I'm always driven by valuations in terms of where we are. The valuations still continue to be high, particularly so in mid and small caps. Those people who are extremely positive on mid and small caps, and I keep hearing these stories, Harsh, about this is a new India, this is a new paradigm, such great businesses are being floated. Why should mid caps trade, at valuations that they used to be 10 years back? Now, I don't believe in all of this. This time is different is a very, very dangerous conversation to ever have. So, yeah, these are the risks I think one should be conscious about. Yeah.
From market risk to individual behavior risk. And this is our last question. So, why I'm asking this question particularly is because generally we regard you as one of the fund managers or CIOs who prefers discipline over forecasts. And we strongly feel that, that's the right way to think about things. Now, if an individual gets 2026 wrong with respect to his or her portfolio, what do you think would be the biggest discipline failure?
Look, I would say at this juncture, and I will connect this to the first question that you people had asked. I would say at this juncture, there is a lot of belief around mid and small caps being one of those asset classes which can just continue giving us somewhere between 15 to 20% return year after year. There seems to be, for some strange reason, a massive belief and conviction around this. I would say that this will be put to test. I do not wish to sound so pessimistic, Harsh. I'm not so pessimistic about the overall markets, by the way, but small caps to a great extent, to a lesser extent, mid caps, I think the pain is prolonged. The pain is not only to 2026, it may even last into some part of 2027. These stocks have to correct and come down to realistic valuations for them to be great investments. So, yeah, I mean, pain ahead into certain parts of the market that I just said. Overall markets may just drift sideways for some time, but certain parts of the market are massively overheated. Anything which is a narrative drawn thing, once again, and this is not just about mid and small caps. Anything where people are investing just on account of narratives, there will be disappointment. So coming back to the discipline ought to be in terms of how you evaluate companies. Please don't lose that discipline. Please don't say that, look, I know that traditionally these are the tools used to evaluate companies, but I'll make an exception because this is such a strong narrative. Let's just not focus on profits for the next few years. Look at how this industry can get into something really big. These are very, very dangerous traits and dangerous behaviors. Yeah.
Understood, sir. So avoiding narratives is something which we will also abide by this year, and I think we will go back to the fundamentals of asset allocations. So with this, we come to the end of our conversation, and it was extremely enriching conversation. I have a list of the points and the learnings which we will carry forward in 2026. Maybe I'll summarize a few of those for the benefit of our viewers. One is that markets are all about having a plan, discipline, and behavioral stability. One should be very, very cautious about not extrapolating last 5 years of equity market returns for the next 5 years. Then you elaborated how one should go by the potential return which one can generate from the equity market, where you gave us a formula of real GDP plus inflation plus fund manager alpha along with dividend yield, and the ideal return expectation over a 10-15 years period should be maybe somewhere in the range of 12 to 14%. Returns which we have got in the last few years, which have been higher than 13-14%, have actually been borrowed from the future. And in investing, if it is boring, it's actually good. If it is exciting, it's very dangerous. Uh, you said that you will not be very surprised if the market remains sideways for next 6 to 9 months, and then you gave very good example of SIP in Nifty 50, where you did analysis for last 20 years, and where you found out that in 25% of the instances, investors actually made single digit returns, and some of those time periods actually had very high inflation also. So the real return was much lower than what an investor is actually made in last 1 year on Nifty 50, because inflation was very benign. Um, Fixed income is not a tool for maximizing return. It's to ensure that your risk is managed and it's a buffer in the portfolio to capture those downside risks in the market. And you gave example of 2008 globally and 2018 in India. The biggest risk in investment, which one should keep in mind, is the permanent loss of capital and not the volatility. Then one example which I really liked was comparing micro market in real estate to real estate industry in general is like comparing Bajaj Finance to Nifty 50, or comparing, say, Nvidia to S&P 500. And I think that is something which we will use a lot in our conversation with our investors. You mentioned that if you go by the trailing period return of gold, and if it is higher than S&P 500, then maybe it is a time to be a little more careful about gold, because generally that indicates peaking out. But this time there are certain other variables at play, especially central bank buying, where we don't have a clarity on how geopolitics will decide the course of action of central banks. And toward the end, we discussed about the risks in the market. And one risk which you discussed was about AI companies, but you also said that it's not a risk like at the beginning of the millennium, where the balance sheet of the companies was not very strong, but still strong balance sheet also, sir. If you see Cisco, whatever price it saw in stock in 2000 is what it touched a few days back. So it took 25 years for a strong balance sheet company like Cisco also to recover in terms of the original price. So I think investors should be a little careful about it. Maybe the companies will survive, they will not go out of business. But as a stock market investor, you should be careful about what price you're paying for the expected growth. And lastly, you mentioned about don't use something like this time is different, especially with respect to mid cap and small cap valuation. But one punch which I will carry from this conversation, not for 2026, but going forward for a very long period of time, is that EQ is more important than IQ, even in investing. We used to think that it's more important in personal life, but I think it's more important in investing, also, what you mentioned. With this, we end our conversation, and I feel if our investors get even 20-25% of this conversation, they can feel that, this is a very good start for this year. And with this, we wish you, your family, your team at UTI a very happy and prosperous 2026. And we echo the same feeling for our investors or viewers who are watching this. Thank you.
Thank you, Harsh. Thank you, Megha. It was so fantastic, replying to all of those questions, which you, I'm sure, have carefully crafted for the benefit of your investors. Let me just add by saying that we interact with a lot of advisors across the country, but it's a pleasure to see advisors like you who bring in process in front of everything else, and it's always a delight, to be in a conversation with you because we love people who keep the interest of clients much before their own interests. And I think that's what you and your entire team at Zyvest have been doing. So wish you all the very best for 2026.